You know that feeling when you look at your paycheck and think, wait, where did all my money go? Like, you know what you're supposed to be making, you know your salary, but then the direct deposit hits, you open the pay stub, and it's just this wall of numbers and codes and tiny deductions. And your brain basically goes, yeah, that seems fine, I guess, and you close it. Here's the thing. For a lot of people, that moment where you don't ask questions is costing you thousands of dollars every single year. Not because you're bad with money, not because you're irresponsible, but because your paycheck is literally designed to hide three really sneaky money traps that almost nobody talks about. And what most people don't realize is if all you ever do is look at the net pay line and move on, you're basically agreeing to play a game that's rigged against you. My name is William, and I spend way too much time thinking about the three money traps hidden inside every paycheck. If you're someone who feels like you work hard, you have a good income on paper, but somehow your bank account never really reflects it, and you don't totally understand where your money disappears to, be sure to subscribe and like this video if it helps you. Because in this video, we're going to go line by line through a paycheck, and I'm going to show you how the tax system uses something called withholding games to quietly steal your cash flow, how your employer's benefit system is set up so that doing nothing is usually the most expensive option, and how so-called convenience features like 401k loans and company stock plans can trap you without you ever feeling it. And by the end, you'll not only understand what's going on, you'll know exactly what to change so your next paycheck actually works for you instead of against you. Let's start with trap number 1, because this one hits literally everyone with a job. Trap number 1, the withholding game. Why does my tax refund feel so good? Look, I get it. Tax refunds feel amazing. You file your return and boom, $2,000, $3,000, sometimes $5,000 drops into your account. It feels like free money. It feels like you won at taxes this year. But here's what most people don't realize. That refund is just your own money coming back to you with zero interest. You basically gave the government a free loan for 12 months. According to the IRS, the average U.S. tax refund in 2024 was a little over $3,000. In Canada, the CRA says the average refund is usually around $1,800 to $2,000. That means tens of millions of people are overpaying hundreds of dollars every month without noticing it. Now, you might be thinking, okay, but who cares? I like getting a big refund. It's like forced savings. And sure, it feels that way, but let's do the math. Let's say your refund this year was $3,000. That means you overpaid about $250 every single month. If instead of giving that $250 to the government, you kept it in your paycheck and invested it, nothing crazy, just a broad index fund that's say 7% per year, over 20 years that turns into around $130,000. One tiny form, one small change in withholding, and we're talking about a six-figure difference in your net worth. That's not forced savings. That's forced lost opportunity. Why does this happen? Because of how withholding works. In the US, when you start a job, you fill out a W-4. In Canada, it's your TD-1 or provincial forms. Most people fill it out once when they're half distracted, hand it to HR, and never think about it again. But your life changes. You get married, you get divorced, you have kids, you pick up a side hustle, you buy a house, your deductions change, your tax credits change, your actual tax situation changes, but your withholding doesn't. So your employer keeps taking the same percentage out of every paycheck based on old information, and you don't notice because your brain only looks at one number, the net pay. And this is where it gets really interesting. The system is actually designed to make over-withholding feel good. Government agencies know that people are less angry when they get a refund than when they owe money. So the default settings are built to err on the side of taking too much, not too little. Now, the flip side is also dangerous. If you have a side business, gig work, or get paid in bonuses or stock, you might actually be under withholding, meaning you feel rich all year and then get slammed with a $4,000 bill in April. Those bonuses, in the US, they're often withheld at a flat 22% federal rate. But if your real marginal tax bracket is 32%, you're 10% short on every bonus dollar. On a $10,000 bonus, that's a surprise $1,000 you owe later. Same thing in Canada with irregular income or gig work. You get no tax taken out at all until you file. So how do you fix this? You don't guess, you use the tools. In the US, the IRS has a free online tax withholding estimator. In Canada, there are CRA paycheck calculators. You plug in your actual situation, your spouse, dependents, side income, and it tells you how much should be withheld. Then you go back to your payroll department and update your W-4 or TD-1. The goal is not a huge refund. The goal is to land roughly in the $0 to $1,000 refund range. Anything beyond that, you're handing out free loans. Anything below that, you're setting yourself up for stress. The big mindset shift here is your paycheck isn't just something that happens to you. It's something you're allowed to adjust. You're allowed to optimize it. And that's just trap number one, because even if your withholding is perfect, there's an entire second layer that quietly drains money from your paycheck before you ever see it. Trap number two, benefit defaults. Doing nothing is the most expensive option. Let's talk about your workplace benefits. Health insurance, retirement plan, life insurance, disability, maybe dental, vision, an HSA or FSA if you're in the US, or a group RRSP and extended health in Canada. On paper, all of that sounds great, but here's what most people don't realize. The default options in those benefit systems are almost never designed to maximize your wealth. They're designed to maximize participation, profit, and simplicity for the employer and the providers. So when you just click Next, Next, Next during enrollment, or when you never log in at all and accept whatever your company picked for you, you're usually picking the most expensive path by accident. Let's start with the retirement plan, because this one is huge. In a typical 401k in the US or group RRSP in Canada, there's a menu of funds you can choose from. Some of them are broad index funds with super low fees, like 0.05% or 0.10% per year. Others are actively managed funds with fees of 1%, 1.5%, even 2%. And guess which ones are often set as the default? Target date funds or balanced funds that are easy to explain in a brochure, but not always the cheapest. Now, are target date funds evil? No. For some people, they're fine. But the fee difference matters more than people think. Here's a real example. Two people both invest $400 a month for 30 years. They both earn 8% before fees. Person A is in a low-cost index fund at 0.05%. Person B is in a 1.5% expense ratio fund. After 30 years, Person A ends up with around $560,000. Person B, closer to $420,000. The difference, over $140,000, didn't go to better performance. It went to fees, to the fund company, to the provider, all because of a default that you might have never questioned. Now, you might be thinking, okay, but I don't know how to choose funds. That's why I let the default pick for me. And that's fair. This stuff isn't taught in school. But there's a simple rule of thumb anyone can use. If your plan offers a broad US total market index, an S&P 500 index, a total world index, or in Canada, a TSX composite or global index, with an expense ratio under about 0.20%, that's usually going to beat 90% of the fancy expensive funds over the long term. You don't need to be perfect. You just need to not be bled by fees. Okay, that's retirement. Now let's look at insurance, because this is another place where inertia is expensive. Many companies auto-enroll you in life insurance and disability insurance. Sometimes the base level is free. That's great. But then there are these little check boxes for optional or voluntary coverage. Maybe it's an extra 2x your salary in life insurance. Maybe it's accidental death and dismemberment. Maybe it's short-term disability that duplicates coverage you already have from the government or another policy. And if you're not careful, you just think, yeah, more protection sounds good, and you click yes to everything. Look at your paycheck. You might see lines like Vol Life, LTD Buy-Up, AD&D, Supplemental. Each of those might be $10, $20, $40 a month.
not huge on its own, but stack them, and maybe you're paying 100 plus every month for insurance that either you don't actually need for your life situation, or you could get significantly cheaper on your own. For example, if you're 24, single, no kids, no mortgage, do you really need an extra $500,000 of life insurance through work? Who's that payout for? I'm not saying never buy insurance. I'm saying don't buy it just because a form made it the easy button. Then there's the opposite trap, not using the good benefits that actually help you. In the US, that's often an HSA, a health savings account. For people with a high deductible health plan, it's one of the best tax shelters that exists. Pre-tax going in, tax-free growth, tax-free for qualifying medical expenses. Yet millions of people never open it, or they treat it like a checking account instead of investing it, because HR never really explains it. In Canada, tons of workers ignore group RRSP matching or pension contributions, which is literally free money their employer is offering, and it never shows up because they didn't tick the right box. So, how do you fix this whole benefit default trap? Once a year, usually during open enrollment, or right now if you've never done it, you log into your benefits portal and check 3 things. In your retirement plan, what are the expense ratios on your funds? Can you switch to a low-cost index fund? In your insurance, are you paying for coverage that doesn't match your life? No dependents? Maybe you don't need extra life insurance yet. And are you leaving free money on the table, like company match, HSA contributions, or a pension that you're not fully funding? It might take an hour, but that 1 hour can be worth tens of thousands of dollars over your career. Now, that brings us to trap number 3, the one almost nobody thinks about until it's way too late.
Trap number 3, auto upgrades and convenience features, the silent paycheck killers. This last trap is sneaky because on paper, these features sound helpful. HR will even brag about them. We offer 401k loans so you can borrow from yourself. We have an amazing employee stock purchase plan. We can automatically increase your contribution so you don't have to think about it. All of that sounds great. It's sold as convenience, but convenience without awareness is where money goes to die. Let's start with 401k loans or similar loans against your retirement account. The pitch is you're borrowing from yourself and you're paying yourself back with interest. And technically, yes, the interest you pay goes back into your account. But here's what most people don't realize. You're taking that money out of the market. So if the market goes up 20% while your money's on the sidelines, you just miss that entire gain. If you leave your job, voluntarily or not, most plans require you to repay the loan quickly, often within 60 to 90 days. If you can't, it's treated as a withdrawal. In the US, that means income tax plus a 10% penalty if you're under 59.5. In Canada, similar withdrawals from locked-in plans can be heavily taxed or restricted. In other words, that convenient loan can turn into a surprise tax bomb the moment you change jobs. Let's do a simple example. You borrow $10,000 from your 401k for a car. The market is down, you're nervous, so you feel good about pulling the money out. Over the next 5 years, if that $10,000 had stayed invested, earning, say, 8% a year, it would have grown to nearly $14,700. Instead, you took it out, paid it back slowly, and maybe your job changed, then you got hit with taxes and penalties. That's a potential 5-figure mistake. Next, company stock and ESPPs, employee stock purchase plans. Don't get me wrong, ESPPs can be amazing if used correctly. A lot of plans let you buy company stock at a 10 to 15% discount, sometimes based on the lower price from the beginning or end of the purchase period. Used smartly, that's almost guaranteed instant profit. The trap is when you never sell. You let that company stock accumulate. It feels loyal. It feels exciting. You're proud to own a chunk of your employer. Before you know it, 20%, 30%, 50% of your entire net worth is tied to one company. Here's the problem. Your income is already tied to that company. If they have a bad year, you might lose your job and see your savings tank at the same time. Ask anyone who worked at Enron, Nortel, Lehman Brothers, or any big company that blew up.
The people who got hurt the worst were the ones whose paychecks and portfolios were both tied to the same ship. A common rule of thumb from financial planners is try not to let any single stock be more than about 5 to 10% of your net worth. With employer stock, I'd argue closer to 5%. So if you use an ESPP, awesome. Take the discount, then set a rule for yourself. When those shares vest or are purchased, you sell them and move the money into a diversified fund. Don't let loyalty turn into concentration risk. There's one more sub-trap under this auto upgrade category: expenses that sneak into payroll because they don't feel like spending. Parking passes, on-site gym memberships, meal plans, premium benefit options, union dues for optional coverage, wellness programs. Individually, maybe it's $15 here, $30 there, but they're dangerous because you never actually swipe a card. You never feel the pain of paying. It's just a slightly smaller paycheck. This is the same psychology credit cards use. If you don't physically hand over cash, it doesn't feel as real, so you spend more. To fix this, you do something very few people ever do. You audit your paycheck like a business audits its expenses. Once a year, or honestly, right after watching this video, you grab your latest pay stub, highlight every single line item that's not absolutely obvious to you, then either call HR or log into the portal and figure out, what is this? Do I still want it? Is there a cheaper alternative? Any optional deduction that doesn't clearly improve your life or your long-term wealth, turn it off.
Putting it all together, how to take back control of your paycheck. Let's zoom out. We've talked about 3 big paycheck traps. Withholding games, where your tax system quietly takes too much or too little because your forms are outdated and you either give away interest-free loans or set yourself up for painful tax bills. Benefit defaults, where doing nothing often means getting stuck in high-fee funds, unnecessary insurance, and missing out on the benefits that actually help you. Auto upgrades and convenience features like 401k loans, over-concentrated employer stock, and invisible payroll deductions that silently drain your net worth. On the surface, these look like small things, a few dollars here, a few dollars there, but the math says otherwise. A $250 per month over withholding issue, plus $60 a month of useless insurance, plus a $10,000 401k loan at the wrong time, that can easily add up to 6 figures of lost wealth over your working life. And the psychology behind all of this is simple. Systems are built around defaults. Humans are lazy. We're busy. We trust that if something is set up for us, it's probably fine. Companies, governments, and financial providers know that. They design the default in a way that works best for them, not for you. So the big shift you need to make is this. Stop treating your paycheck like a mystery box and start treating it like a contract you are allowed to renegotiate. You don't have to understand every piece of the tax code. You don't have to become an expert investor. You just have to ask better questions. Why is this much tax coming out, and is it accurate from my situation? What are the actual fees on the funds I'm invested in? Do I truly need this insurance right now, or did I just never uncheck the box? How much of my future is tied up in my employer stock? What is this $27 deduction that I don't even recognize? And then make small, boring adjustments. Update your W-4 or TD-1. Move your 401k or RRSP contributions into a low-cost index fund. Cancel the optional coverage you don't need. Set strict rules for how you use ESPPs and loans. Those aren't dramatic moves. You're not flipping houses or day trading options. You're just patching 3 leaks in a boat you're going to be on for 30 to 40 years. But over time, that's the difference between I make decent money, but I'm always broke, and I make the same money, but somehow everything feels easier. So here's your challenge. After this video, don't just nod and move on. Pull up your last pay stub. Circle every number you don't understand. If you can't explain a deduction in 1 sentence, literally out loud, you put it on a list. Then, this week, talk to HR.
call your payroll department or log into your benefits portal and start changing the defaults that don't serve you. Because nobody cares about your paycheck more than you do. Not your employer, not the fund company, not the government. If you found this helpful and you want more deep dives into the everyday money traps that almost nobody talks about, make sure you subscribe and hit like so this video reaches more people who are quietly losing money every 2 weeks and don't even know it. Thanks for watching, and I'll see you in the next one.